This has been the hot topic of conversation for well over a year. Everyone has an opinion on whether or not we are on the verge of another housing bubble. So, let's take a look at the numbers and do some data mining.
There is so much in the media today about affordability and affordability being out of control, affordability being something where people cannot purchase homes. It's going to cause another crash in the housing market. There are so many misconceptions, so we'll start at the very beginning. It should be noted that affordability in United States right now is at one of the best levels in history. It's with prices going up, so how can that be? We'll address that, but first let's understand that many people look at affordability because it's obviously important. However, the metrics that they use are oftentimes incorrect. Just because home prices are going up does not necessarily mean they're less affordable, but it can be a contributing factor, of course. So what we want to do first is make sure that we're looking at the right metrics, and the media does not do that. They look at something called median home price. The median home price literally means that half of the homes were purchased above that median home price and half below, which is why it's the median home price. That metric recently has gone up over 15%, but that's simply because there is much less inventory on the lower end, so there are fewer transactions on the lower end, and that moves the median home price up. Doesn't mean home prices are actually going up that much. Home prices are actually going up as measured most recently around 7%. Now that's still pretty big, but 7% can be something that's ahead of what people are seeing as increases in their income. Once again, we want to look at the right metric. Let's look at income over the past couple of years. So many people look at hourly earnings, and that's the wrong metric. You want to look at weekly earnings because you can work more or less hours, but your weekly earnings, that's what you get, and weekly earnings recently have been going up at about 5.9% year over year. Now somebody might still say, well, weekly earnings are less than appreciation. Okay, let's also take that myth out of play. Now let's assume for a minute we're going to do some simple terms here. A year ago could have purchased a home, and the monthly payment for principal and interest, just the principal and interest, would have been $1,000 a month, and to qualify for that, your income would have been roughly $5,000. That's just the average. We got this data from Fannie Mae and Freddie Mac. So we look at these numbers for principal and interest at $1,000 a month and income for $5,000 a month. That's what it would have been a year ago, except a year ago, you did not make the purchase of the home because maybe you listened to people in the media. Now this year you realize after talking to someone like us that housing is a great opportunity, so they want to move forward. But now home prices went up by 5%. Now in this particular instance, let's just say interest rates remain the same. So that means that they have to borrow 5% more, which means that their payment would go up by 5%. That means their payment would see a 5% rise, which brings the payment to $1,050 a month. So that 5% rise is $50 a month. It's 5% of $1,000, so their total monthly payment is $1,050. At $1,050 for the monthly payment means that is $50 more a month they need to get as an increase in income to offset that. So that means their income would have to rise from $5,000 a month to $5,050 a month to offset that in order to be at the same level of affordability. So what percentage rise in income did they need to make that extra $50 a month? It's not 5% rise, it is 1%. So this is a misconception because when you look at the math numbers, you don't use all of your money from your income for housing, you use a fraction of that. Because of this, you don't need as much of a rise in income to offset an increase in home prices, and this is a very important concept. Now to tie this all together, let us take a look at an example. Let us just say we are looking at something in the fourth quarter of 2019 versus the fourth quarter of 2020, and somebody today is looking at a home, but the home has seen 7% home price appreciation over the past year, and today that home is now priced at $350,000. Now because that home appreciated at 7% a year ago, that home was worth approximately $327,000. In the last year, thanks to appreciation, the home has gained $22,900. It obviously would have been better to have bought it last year, but home values are expected to continue to rise, and when it comes to affordability, let us take a quick peek at what has happened. The 30-year fixed rate a year ago was 3.75%. Today it is around 2.75%, and I know these numbers can change, but we are using this more for conceptual purposes, so we have seen about a 1% drop in interest rates year over year. A loan amount, let's say they are putting 10% down, so a 90% loan to value, which means they borrowed roughly $294,400, and today that is $315,000 borrowed. So they have to borrow $20,600 more in order to make this transaction happen. That is where the media says, well, now it is less affordable because you have to borrow more money. That means you are going to have more in monthly payment. but because rates have dropped so much instead of last year's payment on the lower-priced home value, I should say, would be $1,063. Today, even with that home appreciating to make that same monthly payment on 90% financing, it would be less by $77. Now, in all fairness, the loan amount's bigger. It is 10% down, so you might have to pay more in mortgage insurance. So let us calculate that. The mortgage insurance will depend, of course, on credit score. We understand that, but just to give some general numbers, it is about $8 a month more in mortgage insurance, so that brings your net lower payment this year versus last year to $69 a month. So the same home is going to cost you $69 a month less, even though it went up almost $23,000 in price. The media sees the price gain and they say, well, it is less affordable, when in reality, when you do the math, it is more affordable, but it goes much deeper than that. Now let's be fair about this and let's understand that the down payment on a lower-priced home is less than a higher-priced home, so there is about $2,290 more in cash that they would need. If you would translate this into a difference in monthly payment, it would be about $10 a month. If you were to in some cases finance this, and I don't want to go in too deep on the differences in mortgage insurance, but in many cases this would be $10, maybe it is $15. Whatever it is on a monthly basis you would be looking at, if you wanted to finance this difference instead of putting it into a cash down payment. So you see, when you put it all together and you use the right metrics, it is just a myth. Homes are still affordable and consumer buying power has never been higher. Find out your buying power and let us give you a free financial analysis today.